All right, let's talk about something we've all done. You see the price of a house or a new car and you think, okay, I think I can swing that monthly payment. But what's the real cost, the true cost, over time? Today, we're going to pull back the curtain on loans and show you the one number that can literally change your financial future. So yeah, this is the big question, isn't it? How much will it really cost you? And I'm not talking about the sticker price. Nope. I'm talking about the grand total you'll hand over to the bank by the time you've paid it all off. The answer is often pretty shocking, so let's figure out exactly how to calculate it. Okay, to make this super clear, we're not going to talk in abstracts. Let's use a real-world example. Say we're buying a home in Austin, Texas. We're going to walk through this step by step so you can see exactly how these numbers stack up in real life. So you find it, the perfect place. The asking price is $350,000. This is our starting line, the number that everyone gets focused on. Now, you've been saving up like crazy, and you've got $70,000 ready to go for a down payment. That's awesome, and that's money that directly cuts down the amount you're going to need to borrow. So you do the math, and after that down payment, the amount you actually need to get from the bank is $280,000. This right here, this is the principal of your loan. Okay, now this is where it gets really, really important. You have to understand the terms the bank gives you. For our example, let's say we get a 6.5% interest rate, and it's a standard 30-year mortgage on that $280,000 loan. These three numbers, they determine everything. So let's get out the calculator and run these numbers. We're about to find that hidden cost, the one that most people completely miss because they're just looking at that monthly payment. You plug those numbers in and boom, the calculator spits out your monthly payment, $1,770. Now, you look at your budget and you think, okay, that seems doable. But this, my friends, is where the story takes a turn. Just think about it. What happens when you pay that $1,770 month after month for 360 months straight? I'll tell you what, the total isn't the $280,000 you borrowed. It's not even close. Over the full life of that loan, your payments will add up to, wait for it, $637,000. Just let that sink in for a second. You borrowed $280,000, but you're paying back way, way more than double that. And here it is, the number that really matters. Of that total, a staggering $357,000 is pure interest. That's just the fee you're paying for borrowing the money. And you know why it's so high? Because for the first several years of the loan, almost your entire payment is just going to interest, barely making a dent in what you actually owe. It's crazy. Let me say that again. You are paying the bank more in interest than the amount you needed to buy the house in the first place. This is the perfect example of why just looking at a monthly payment is so misleading. But here's the really cool part. You're not powerless here. There is a very, very simple strategy that can completely flip the script and put a fortune back in your pocket. So let's run a new scenario. What if, on top of that required payment, you decide to pay just an extra $300 a month, and you make sure that extra money goes straight toward the principal? It might not sound like a lot, but you have to see the effect. It's incredible. Check this out. The results are absolutely staggering. By just adding that extra $300, you shave an entire decade off your mortgage. You're done in 20 years instead of 30. And look at the interest. It drops from $357,000 all the way down to $227,000. That is $130,000 in savings. That's money for retirement, for your kids' college, for another investment, all because you had the discipline to pay a little extra each month. We're talking about a life-changing amount of money. And you know, the best thing about this is that this powerful idea isn't just for mortgages. You can apply this same thinking to pretty much any loan you will ever take out. Seriously, think about it. For a car loan, what's the real cost of a 6-year loan versus a 5-year one? For student loans, how much faster could you be totally debt-free by adding just $50 or $100 a month? And oh man, for high-interest credit cards, a calculator will show you the brutal reality of just making those minimum payments. So the key is to take control before you sign anything. Here's a simple little checklist to remember. First, use real numbers. Get the actual interest rates you qualify for. Second, for a house, remember to add in all the costs, like taxes and insurance, to get your true monthly total. And third, Always, always compare scenarios. See what happens with the bigger down payment or with that small extra payment. Nobody really teaches us this stuff in school, but understanding it, well, it's like a financial superpower. A simple calculator gives you the ability to see into the future and make choices that can save you tens or even hundreds of thousands of dollars. So the real question is, what are you going to do with that power?